Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek, insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
And a very good afternoon, everybody, live on radio, TV, YouTube, Bloomberg Originals. This is Bloomberg Business Week for this. Yeah, it's a Fed Wednesday. It is Wednesday, February 19th. Carol Massar, Tim Stenovec. In just a moment, we're going to get the Fed minutes from the meeting, the first meeting of 2025. It happened 3 weeks ago. We're going to head to Washington, D.C. in just a moment, Tim.
Yeah, we're also going inside the world of the world's biggest online dollar store.
Off to D.C. we go, and that's where we find Bloomberg News International Economics and Policy Correspondent Michael McKee. Mike.
We've got some news from the minutes today, as there was a lot of discussion apparently at the last meeting about trade, tariffs, banks, and the balance sheet. While officials saw a strong economy with a solid labor market and declining, if still too high, inflation, they spent a lot of time talking about potential policy changes and financial market supervision. A number of participants suggested the recent rise in monthly inflation was likely due to seasonal factors, noting substantial progress before that, but potential changes to trade and immigration policy from the new administration had the, quote, potential to hinder the disinflation process. One concerning note, business contacts in a number of districts indicated that firms would attempt to pass on to consumers higher input costs arising from potential tariffs. Many said companies were reporting substantial optimism about the economic outlook given potential easing of regulations and tax cuts, but some participants reported increased uncertainty regarding potential changes in federal government policies. Altogether, Fed officials generally pointing to upside risks to inflation from tariffs and immigration policies, geopolitical threats, and stronger than expected consumer spending. They worried it might be hard to distinguish persistent changes in inflation from temporary ones caused by policy changes. There was also discussion of financial market vulnerabilities, including banks' reliance on reciprocal deposits, the risk of unrealized losses at banks and non-bank institutions from any potential rise in long-term interest rates, asset valuations, and commercial real estate exposures. Several commented on concerns that primary dealers didn't have enough intermediation capacity, and the degree of levered positions in the markets was concerning. Finally, on the balance sheet, many participants suggested structuring future purposes as they run off the balance sheet should be done in a way that moved the maturity composition of the Fed's portfolio closer to that of the outstanding stock of Treasury debt. And various participants, that's a new adverb for the Fed, suggested it might be appropriate to consider pausing or slowing balance sheet runoff until the debt ceiling is resolved. They obviously made no decision on that and did not make any decisions on bank supervision, but it does show they were worried about more than just inflation at this last meeting.
All right, Mike, I feel like that there is definitely a follow-up to that various participants point that you made. But let me just quick check on the markets. Equity markets, S&P is up about 4 points. NASDAQ 100 is up about 6 points. So a little bit of a more positive tilt, but call it really slightly. More importantly, let's get to the U.S. Treasury trade. We had a 455 read on the 10-year. It's at 454. The 5-year, if I look at it, was at 438. That's where we find it. Shorter end of the yield curve, most sensitive to what the Fed may say or do. That's exactly at where it was prior to the Fed minutes, and that's with a yield of 428. Hey, Mike, anything in here that beyond the various participants, or that included, that would make investors, traders think differently about what the Fed might do differently from what we got at that Fed meeting?
Not necessarily on monetary policy, and many of the Fed officials who've spoken since the meeting have talked about risks from trade policy and immigration and the fact that they don't know what they can be and they can't quantify them at this point. The bank supervision stuff was interesting because there's been a lot of talk about how strong the banks are, and there's not a lot of concern about that. At the press conference, Jay Powell talked about how SVP was an outlier when that bank failed, but apparently there's more more concern about that. There's also been questions about whether the Fed would change its rules on the supplementary leverage ratio. And obviously, there are concerns about whether dealers have intermediation capacity. And then, of course, finally, the balance sheet stuff is really interesting. It's something that bond traders and bond analysts are going to have to follow closely, because it's possible, I suppose, at the next meeting, if we don't get progress on a debt ceiling from the administration and Congress, they might want to consider pausing the runoff of the balance sheet until that happens.
Is it rare to get something, Mike, in Fed minutes that is so not necessarily targeted, but something that specifically calls out something that could be happening in Washington that Congress has control of?
We don't see a lot of major policy changes from administration to administration that would affect the economy in the way that tariffs and immigration policy might, tax cuts as well. So it is unusual, but it is not an unusual factor of Fed thinking over the last 4 or 5 months, because they've been trying to parse out what might happen and how that might affect the economy. And we still don't have very many details about all that. I think we've got 6 different tariff announcements, but only 1 in place. The rest postponed for a few weeks until this or that happens. So they really don't have an idea of what's going to happen, but they're putting it in the upside risks category.
Hey, one last question, Mike. So if Jay Powell was holding a press conference today off of these minutes, what would you ask him?
Yeah. Well, since everybody else before me would probably ask about upside risks to inflation, I'd be interested to know more about the balance sheet and what they're really thinking there. Obviously, the Fed, when it lets them its securities roll off up to a limit of 30 billion a month, then the rest of the rolling off money goes back into the Treasury. And there's been a lot of talk about the maturity curve for the Treasury, because the Biden administration bought a lot of short-term bills, short-term bonds, and now we're looking at longer-term perhaps losses, because interest rates are going to go higher, but the Fed is now talking about maybe we want to go that direction. So a very interesting question ahead for the bond market.
All right. Bloomberg News international economics and policy correspondent Michael McKee out there in Washington, D.C. All right. Let's get to any market reaction when it comes to the U.S. rates trade. And we've got a great guest for that.
Let's bring in Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey. He's out there at Bloomberg Intelligence headquarters in Princeton, New Jersey. Ira, why the lack of reaction to this, to the news in the minutes from the Federal Reserve?
Because there's a lot of interesting details, but nothing new. One of the issues that we get is with the chair's press conference after the meeting is we know 90+% of what's likely to be in the minutes. So it's really around the edges that you look for things. So it is those adverbs that Mike was just talking about. So you look at were there many members that thought something that was different than maybe what was expressed by Chair Powell, or was it just a couple, right? So that's a kind of the nuance that we get out of the minutes. I'm focusing on the minutes here, looking at some of the statements done by the SOMA portfolio manager, who that has to do with quantitative tightening and what they might end up doing with the balance sheet. So there is some interesting information in there that we didn't have before, and obviously the Fed is still a long time from stopping QT, but now we're getting a hint as to what they might do if they end their asset runoff and quantitative tightening.
Well, Ira, are you like Mike, that you would want, if you were posing a question to Jay Powell, if there was a press conference after the Fed minutes, like there is after the Fed decision, would you ask about the balance sheet, or is there something else you'd want to know based on the headlines we've gotten?
Probably mostly about the balance sheet at this point, because we know, and some of the interesting statements in there, did follow up as you were talking about a moment ago. There have been a lot of speakers since the meeting, right? So, and most of those speakers have said we can be patient, we can wait. There's risks to the upside. There was one interesting headline that came over the terminal, and I have not yet read it in the minutes. Obviously, the minutes are like 30 pages long, so it's taken a little while. But they did say, until inflation starts to move more toward their goal, they can be patient and wait. So I think, while not exactly new, I think that was just a confirmation that members of the Federal Reserve are happy with where rates are, given the overall economic environment that we've been seeing in a lot of the data, particularly that inflation data.
If we do indeed see policies from the Trump administration that are indeed inflationary, tariffs, immigration policy, is it a realistic thing to say, Ira, that the next move from the Fed could be a move higher?
Well, I think that depends in what everything else is doing in the economy, right? Because the Federal Reserve, unlike most other central banks, does have their dual mandate, right? So I think there's two things. Is one, they have been harping, and some members have been harping on the idea that they're not near the neutral rate. That for some reason, a lot of members of the Federal Reserve think that the neutral rate is probably closer to 2.5% or 3% instead of 4%. I actually think it's closer to 3.75% or 4%. So I think we're probably pretty close to that. But there's a difference of opinion, right? Because it's not something you can observe ex ante. You have to wait until events happen, and you only know if you were at the neutral rate, at some time in the past when you look at history. So, so I do think that the Fed itself is going to have to think about, hey, what do tariffs mean for inflation in the long term and the short term? And if inflation does go up and inflation expectations rise and the job market is still okay, then the Fed will sit on their hands and maybe they will hike. But it's more likely that you get tariffs and then you also have maybe some job losses, and that means that the Fed has to decide, hey, are we going to ease a little bit to take back to ease monetary policy in order to try to support the job market, or do we just try to push against these tariff-led inflation?
Hey, just to wrap up, Ira, so, as your research that you put out today, you say you think there is a non-trivial risk that the Fed may need to increase rates to stem a climb in inflation expectations. Market and traders not pricing that in yet, in your view?
Yeah, so the market is not pricing it in. There's a very small chance in some options markets that the Federal Reserve might hike one time over the next year. I think that's probably too low. Like, it's still not our base case. Like, our base case is that the Fed's on hold for the next 12 months. But I think that the market is underpricing the risk that the Fed might have to hike.
All right, going to leave it there. Hey, listen, Ira, thank you so much. So appreciate it. Reaction to what we saw. Of course, Ira Jersey's chief U.S. interest rate strategist here at our Bloomberg Intelligence team out there at BI headquarters in Princeton.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Well, head to its homepage and you will be bombarded with random items. Faux leather car seat covers, frog costumes for cats.
Did not even know.
I think Tim just bought some.
Yeah, I don't have a cat, but the frog costume sounds great.
Knockoff handbags, supplements, whatever. And also a flurry of banners, countdown timers, and prize wheels, hawking deals. Price drops and limited time offers. These are the words of our own Spencer Soper. I mean, this is, Tim, the world of Temu.
Yeah, in just 2 years, it's become the world's biggest online dollar store. Today's Bloomberg Big Take. It's a deep dive into the company and how it got ensnared in President Trump's trade war. With the tell, we welcome back Bloomberg News tech and e-commerce reporter Spencer Soper. He joins us from our Seattle bureau. Spencer, I feel like I'm in the minority because I'm not like a big Temu person. I've never used Temu. I had no idea that the growth of Temu over the last couple of years is a direct result on what happened during Trump's first term. How did it happen?
Yes, so during Trump's first term, if you remember, he imposed these big tariffs on China in particular. And so that basically made this de minimis loophole, which has been a thing for nearly a century now. But there's this tariff loophole that lets you ship in individual packages from China. As long as a package is worth less than $800, it can come into the U.S. for free. So all of a sudden, this shipping method is much more attractive, as opposed to, traditionally, if you go to a store, you buy something on Amazon, it most likely came in a cargo container into a port, and tariffs will be assessed on that. With Temu sending in an individual package to a U.S. shopper, kind of factory direct, it slides in below those tariffs, and that's one thing that gave them a big price advantage.
And then during the Trump administration specifically, didn't various presidents kind of keep raising the amount?
Yeah, the de minimis has always been there. The loophole's always been there. Wish.com benefited from it years ago. What happened, though, was Trump didn't do anything about de minimis. Trump imposed these new tariffs. So all of a sudden, that existing loophole became that much more valuable.
Is that existing loophole at risk right now? There's a lot of confusion over what happens to this loophole in this latest round of tariffs.
Yeah, so Trump said he was going to eliminate the loophole, but then he backtracked because you can't just do it with like a stroke of a pen. Realized that the agencies, particularly like Customs and Border Protection need time to figure out a plan and come up with a plan to how to handle this volume, because we're talking about 4 million packages a day enter the U.S. through this loophole. And so, yes, he signaled that he wants to eliminate it, but exactly how that's going to be and whether there's still some loophole, maybe a smaller loophole or a different loophole or just no loophole, we don't really know until we see exactly how this is going to be implemented.
Spencer, you mentioned this is part of a nearly century-old tax loophole. The people who put this tax loophole into effect, they weren't thinking about cat costumes, including frog costumes for
Maybe
cats.
they were.
Maybe they were coming from China.
No,
What's the history here?
Yeah, when you think about de minimis, de minimis in Latin translates to something of such marginal value to be insignificant, okay? And so when it generally applies to is someone returning, and the origins of it, someone returning from a vacation from another country, they've got loot in their suitcase. Maybe you got some T-shirts, some gifts for your family, that kind of thing. Without the de minimis loophole, you'd have to pay tariffs on that because you're bringing in a product of, from another country of origin, and the duties would apply. But they realized, look, we don't want customs agents bugging every person coming back into the country about what's in their suitcase. So they set this cap, which is currently $800, which is a fairly generous one. So that's what it was intended for, but then you enter the age of e-commerce and cross-border e-commerce, and suddenly you have this big loophole where the same rule applies if Tim orders that cat costume on Temu and it's only $20 or whatever, it can come in under that loophole, and it gives you a price advantage over, say, brick and mortar stores that are bringing products in bulk.
I think he definitely has one under his desk. Hey, Spencer, I got to be honest with you.
Have you ever tried to put a costume on a cat? They're not dogs.
I have on a dog.
Yeah, they're not dogs.
Also slippery.
Yeah.
Hey, Spencer, I think what's interesting is I said to Tim, as Temu has popped up and we were reading your story, I'm like, have you shopped there? And he's like, no, I haven't shopped there. But it's massive. 50 million other U.S. shoppers do. Remind everybody about the size and scope of this, because I feel like if we talk about Amazon, everybody knows who Amazon is. But Temu is pretty impressive, and its growth is really impressive, even versus Amazon.
Yeah, so in just a few years, Temu this year is expected to surpass $30 billion in gross merchandise value, basically the value of all the goods they sell in the U.S. That's a milestone. It took Amazon more than a decade to make, and Temu's going to do that in about 3 years. And the 50 million shoppers is bigger than eBay, bigger than Walmart. So it's really second only to Amazon at this point.
What are people buying there? Because it's not in the sense of Amazon. Amazon's known for getting stuff quickly to your doorstep. That's really what they're priding themselves on when it comes to Prime, as you know, Spencer. What are people buying on Temu, and how has it changed the way that people shop?
It's a little bit of everything, but generally you can think, okay, it's likely going to be something small, something light, even though you can find like a bulldozer on Temu, believe it or not. But generally people are buying things that are small, maybe apparel, small kitchen appliances. I've shopped on there a bit. I do a lot of do-it-yourself projects. I've bought some tools on there. It's generally smaller items. Arts and crafts are popular on there. Things for like a party. If you're throwing a party, it's popular on there. I've heard of a lot of teachers who will maybe shop there as opposed to going to Dollar Tree or something to get gifts for their students to motivate them, that kind of thing. So there's a whole variety of reasons and a whole bunch of things you can buy on there, but it can be very, very random.
Contrast the experience a little bit with Amazon, not the experience of actually using the website or using the app, more so the experience of how stuff gets to your doorstep, because Amazon has built up this network of distribution centers. They have employees throughout the country trying to get that product close to you very quickly. It's already in the U.S., even if it was made in China or in another country. How does something get to you from Temu?
Yeah, so Temu, and they're shifting based on this tariff loophole being changed, and they could see that coming. But initially, generally it's coming from a factory in China to a warehouse in China, and then packed in that warehouse in China, and then put on a plane into maybe JFK or LAX, and then to your house. So it might take a week, 10 days. But that contrasts with Amazon, where they call it like forward deployed. The inventory is already in the United States before you even order it, and that's why they can get it to you so quickly. So what Temu's proven is hey, Amazon, you're big on 2-day delivery, 1-day delivery, same-day delivery. We're finding customers out there that are patient if you give them a good deal, and they really can beat Amazon and a lot of other retailers on their prices, and people are willing to wait for those discounts.
Well, that's what I thought was also interesting in terms of this story that you did. You talk about how they really tapped into, I think one of the founders of Temu's parent, PDD, the rise of the budget-conscious consumer. And so they've really tapped into that, and something that Amazon has definitely noticed as well.
Yeah, I mean, if you think about the timing of it, right, they came right after the pandemic when people were just willing to shop virtually anywhere because people were so desperate to get things during the pandemic. So any hesitation about a new site kind of went away. That was a lasting change in habits. Then we got hit with inflation. So all of a sudden people were like, hey, where can I find a deal? So Temu struck that nerve. And they had the timing right. It was the right product at the right time.
Yeah, I'm interested in what happens in China, not just at these products, but not just when these products are made, but at a place like PDD. The story does dive into that a little bit.
Oh, about PDD, basically they had luck in China, what they called the forgotten consumer. So, Alibaba was long the leading e-commerce company in China, and they, similar to Amazon, they really focused on urban areas and more affluent urban customers. And PDD said, look, let's focus on people in more rural areas that still want deals. And a lot of it was kind of a Groupon-esque buying environment, like you would buy collectively with a group of other people to get better discounts. And so that's kind of the origins there. But then they're applying that similar philosophy in the U.S., looking for the folks. Things that maybe they want that they can't buy or at prices they can't find.
Spencer, will they be able to deliver on this if that tax loophole goes away?
That's a great question, and that's what everyone's wondering. They've already been preparing for it by getting more warehouse space in the U.S. and having more inventory in the U.S. and even cultivating relationships with U.S.-based merchants. So it looks like they're already gearing up toward that. And then exactly how these tariffs play out, I mean, these things generally aren't, one catastrophic ending to everybody. There's going to be some people who navigate it and survive. We might see further delineation in the categories. Maybe some categories survive and others don't. But I don't think we've seen the last of Temu here. Yeah,
and I got to just say, just to wrap up, just got about a minute here, Spencer, is that you write about the culture of the company of PDD and Temu, and sounds
there's
like
a Severance reference in there. That's all I'm saying.
Sounds like there's some long working days, and that they will not give up easily. Just some insight into the company's culture.
Yeah, well, they say 11-11-6, which is kind of a play off of Alibaba's 9-9-6. Basically, people working 11 a.m. to 11 p.m. 6 days a week. Long, grueling hours. It's hard to fault them for that. I mean, I'm sure you can find examples of that in the U.S. But yes, it's known for hiring smart people and motivating them with money. But they're gonna earn it. They're gonna work their tails off.
All right, we're going to leave it there. Hey, Spencer, thank you so much. Glad we could get some time with you. Spencer Soper, technology and e-commerce reporter here at Bloomberg News, joining us from our bureau in Seattle. This is the Bloomberg Big Take today.
Everybody check it out at bloomberg.com/big take and also at bloomberg.com/businessweek.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, more than 100 million people are facing frigid conditions across the eastern and central United States, and that includes the entire state of Texas, as an Arctic blast threatens to break low temperature records. The Electric Reliability Council of Texas, that's the state's grid operator, said electricity demand will jump in the coming days, but it expects to be able to meet the spike in consumption. Now, regulators and lawmakers have moved to bolster the state's power system after the grid collapsed during a series of winter storms back in 2021, killing hundreds of people as homes and businesses businesses were left in the dark. Someone who knows a lot about the grid system overall in the United States, but in particular the Texas state grid, is our next guest. Zach Dell is co-founder and CEO of Base Power Company. He joins us from the Bloomberg News Bureau in Houston. Zach, great to have you here with us. Let's start with Texas. So known, of course, for oil and drilling. It's a leader, too, though, in renewables like wind and solar. Tell us, first of all, about the power mix in the Lone Star State and the economic models for selling electricity. What should kind of the investing audience understand about the state of Texas?
Well, Texas is the energy capital of the country. It leads the country in renewable generation. We have more wind and more solar than almost anywhere in the country. And that's because Texas is the middle of the wind corridor. It's in the middle of the Sun Belt. And it's a great place to develop energy infrastructure. It's a free market. It's a deregulated energy market for the most part. ERCOT is one of the largest electricity markets in the country. And so it's a great place to build energy technology. That's why we've decided to start the company here in Texas. But it's also a part of the country that's seen incredible population growth. It's seen incredible growth in heavy industry. And that's put a lot of stress on the grid. And so we started the company to increase our capacity for energy consumption and add resources to the power grid in the form of distributed battery storage to help absorb some of that growth, absorb some of that demand, and set us up for a future of energy abundance and human prosperity here in the state.
Zach, explain where exactly the company lives on the grid in the sense of, okay, it's not necessarily a utility, it's not necessarily an energy provider. How do you define it?
Exactly. So we are a distributed energy technology company. So we deploy our storage assets on the grid edge, on site with our customers. So we install batteries on homes today. Customers sign up for Base Power. We go install our battery on their home. When the grid is up and running, we use that battery to support the power grid in times of high demand. And when the grid goes down, the customer gets that battery to protect their home from power outages.
Well, and tell us about it, like a customer that signs up, Zach, exactly what are they getting? They're getting batteries, right? And there's installation that's involved. I'm curious about how it works, what they get. My understanding is the batteries are big, what it costs. Give us an idea.
Yes, so customers sign up and pay $495 up front and $16 a month and get all the benefits of home backup protection without the high upfront cost of buying a large generator or buying a traditional home battery. So we install a battery that's 25 kilowatt hours for one system, and you can get two systems installed, which get you to 50 kilowatt hours, which will protect your home for up to 1 to 2 days, depending on the size of the home, in the event of a power outage. So you get a really large battery for a really low upfront cost and a low monthly fee, cheaper than a gym membership, cheaper than a Netflix subscription, cheaper than Amazon Prime. And when the grid's up and running, you're buying your electricity from us. We're able to save you 10 to 20% a month on power. And when the grid goes down, you get to protect your home, keep that fridge going, keep your AC running, keep your lights on, and keep your family safe.
Zach, we're talking about this in the context of Texas, of course, and a lot of focus has been on Texas's grid. Also, California's grid, another state that comes into focus. Any plans to expand to California?
Absolutely. I mean, we hope to be in all 50 states over the next couple of years, and we're working to partner with some of the regulated utilities in states like California that don't have a deregulated energy market. Texas is an amazing place to start the business because the vast majority of the state, about 80%, is deregulated. So we are actually a retail electric provider and a battery developer. So we sell power directly to the homeowner, and then we own and operate the batteries on site. In a state like California, you have regulated utilities like LADWP and PG&E that have kind of geographic monopolies over certain areas. And so we'll partner directly with those regulated utilities, provide our hardware and software to them to enter those markets.
And from what I understand too, Zach, that the success of the company is contingent on more and more people, right, signing up, right? You need to kind of have a network.
Well, not necessarily. We're able to operate our batteries at the individual level. So we don't necessarily, there's not like traditional network effect benefits to more people signing up, but obviously businesses benefit from scale, and we benefit from scale in the same ways. But it's not like the system doesn't work well if a couple people in the neighborhood have it. There's really no meaningful difference if you're the only one in your neighborhood or everyone in your neighborhood has Base Power.
All right, so if you're, as an individual, there's no difference, but what do you get out of building that scale?
Well, we benefit from scale just like most businesses benefit from scale. So we have economies of scale on the supply chain side, on the engineering side, building out our team, our resources. The larger we get, the lower the cost that we can provide to the customer. So our goal as a business is to develop a compounding cost advantage through vertical integration. So we develop our own batteries, we develop our own software, we manage the installation, we sell power directly to the homeowner, and by doing all those things, we can drive the cost down for the customer and deliver the most affordable and most reliable power.
Right, because from what I understand too, you're monitoring what the price is of energy, and so when it goes down, you guys are filling up the batteries, correct?
That's right.
Hey, Zach, if a power company sees what you're doing right now and says, wait a second, that's a really good idea, what's to stop Con Ed or PG&E out in California from basically replicating what you're doing, but they already have the relationship with the customer?
Well, it's very hard. You have to become an expert in battery hardware engineering, power electronics, supply chain operations. You have to deploy these batteries on site. You have to interface directly with the customers. You have to build a consumer brand. There's a lot of interesting and challenging distributed system software problems that you have to solve to deploy this technology. So we're really excited to partner with those utilities and help them deploy battery technology in their service territories. As you guys know, these investor-owned utilities are not incentivized to invest money in OpEx and R&D. They're CapEx-driven businesses. They earn a regulated rate of return on their CapEx, and so their incentive is really to deploy CapEx in their service territory, and they add that into their rate base, and that kind of influences what they end up charging the end consumer. Our business is a little bit different. We're an R&D-driven business. We develop technology, and we bet that technology is going to benefit the customer, and we benefit downstream of that. And so we think that we're an obvious partner to some of these regulated utilities as kind of an R&D partner where we can develop technology and then we can go deploy that technology in their service territory. They benefit, we benefit, and the homeowner benefits as well.
I am also curious, are you profitable, or how many states do you think you have to build, reach out to or expand to before you are profitable?
I don't think about it as a number of states number. It's really about building the fleet and getting to scale. And so, we started the company a little under 2 years ago. We launched a product in May. We've been scaling rapidly. We're doing on the order of 20 battery installations a day. We'll continue to scale up at a faster and faster rate and move outside of Texas in states like California and other states across the country. And we think there's a really attractive kind of economic proposition for the business going forward.
Hey, Zach, we'd be remiss. Your dad, Michael Dell, iconic in the tech world. This isn't the first company you founded. You've worked at PE giant Blackstone, also an investor at Thrive Capital. They, of course, founded by Josh Kushner. They've invested in your company. I am curious about growing up, with your dad. How did your dad influence you?
Well, I think I'm the luckiest guy in the world. I've got the most incredible CEO coach as my dad. We're extremely close. We talk all the time. He's not an investor in the business, but he's a very close advisor and confidant and friend. And I think people always ask me like, oh, why do you want to start a company? And I think it's kind of a silly question because I got to see my dad, live his dream and continue to live his dream. He's still the CEO of Dell. He gets to play the most interesting game at the highest level, and I aspire to do that too. So he's an inspiration. He's a hero. He's a role model. And people like Josh and some of the folks at Blackstone that I've gotten the chance to work with in my career have been kind of similarly inspiring to me. So I'm really excited to follow in his footsteps and try to build something really important for the world.
You said he's not an investor in the company, Zach. Yet, we could say yet. Are you out there planning to raise more money?
We will raise more capital as the business scales. Yes, for sure. I joke with him that he's a late stage investor, so if he wants to invest, he's going to have to pay a high price.
Well done. You've learned well, as they would say. Hey, listen, stay in touch. Let us know as you continue to expand and build out. Stay in touch and love to get some updates. Zach Dell, co-founder and CEO of Base Power Company, joining us from our Houston bureau.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Carol, investors still focused on what's to come regarding tariffs. President Trump mentioned the possibility of tariffs of 25% on autos and pharmaceuticals just yesterday.
Some of the biggest companies in the world, and because of what we're doing economically and through tariffs and taxes and incentives, they want to come back into the United States.
Have you decided specifically what the auto tariff rate should be?
Yeah, I probably will tell you that on April 2nd, but it'll be in the neighborhood of 25%. We want to give them time to come in because, as you know, when they come into the United States and they have their plant or factory here, there is no tariff. So we want to give them a little bit of a chance.
Well, there you have the president just yesterday at Mar-a-Lago talking the latest on tariffs. We continue our talk on tariffs and macro affecting the business and financial market environment. This time with the head of Egnyte. It makes software for enterprise companies to secure and manage massive amounts of data. The company's raised $140 million in venture capital from Google Ventures, Kleiner Perkins, Goldman Sachs, and others. And it counts companies such as Red Bull, Steve Madden, and BioNTech as customers.
Great to have you here with us, Vineet. Let's get to it in terms of what we continue to get from President Trump and the White House regarding tariffs. And again, a lot to be known in terms of the actuality of what gets imposed and for how long. How do you see it as what might be the reality of tariffs in your world?
Hey, Carol. In my world, I'm talking about we are a software as a service provider. So anything that impacts IT systems, whether it's servers, networking gear, data center components, those would be the ones that I would be most interested in, not the autos or pharmaceuticals, although there's always a cascading impact if there's a general inflation. Now, I know the numbers on the tariff side keep ratcheting up. New announcements are coming out regularly. So a couple of Tuesdays back, I think there was a 10% tariff announced for this class of hardware. So the question is, if the underlying data center equipment becomes more expensive, and keep in mind, a lot of it is made in China, will that have an impact on the ultimate end user solutions that companies like ourselves provide? I don't think so, because these cost increases can be absorbed by the providers, including companies like ourselves, with some impact to the gross margin. But it's not significant yet. Unless these numbers start crossing into 25% or higher territory, until then, I would say I'm pretty sanguine about it.
Is the concern, though, compounded when you think about your customers? I mentioned Red Bull, Steve Madden, BioNTech, just a few of your customers. Steve Madden, a company that I would imagine makes products in China. If they're hit with bigger tariffs, then what happens to the amount that they're able to spend on services such as yours?
Oh, absolutely. I think you actually use the right word, compounding, because ultimately any cost increases for our own customers, Steve Madden's a great example. I mean, the fact remains that despite all the effort to move manufacturing out of China to countries like Vietnam, to Malaysia, and even to some in India, China is still the factory of the world. So it's absolutely normal to assume that if they are going to experience cost increases, they being the companies that you mentioned, Steve Madden or whoever else, they will pass it down to the customers. If they can't, it eats up in their gross margin. If they don't want to pass the cost down, then they'll squeeze suppliers like ourselves. So there is absolutely a trickle-down or rather compounding effect, as you eloquently put it.
We are talking with Vineet Jain, co-founder and CEO of Egnyte. He's joining us from Mountain View, California. Vineet, what about global supply chains? Do you think that they will be potentially changed forever? Again, devil in the details when it comes to the particulars around tariffs, what they are on, how large they are, and how long they last. But having said that, I do wonder about the psyche that's changing within the business environment, thinking we need to get out of this mess. Who knows whether it's this administration or what's to come, that maybe we need to have our global supply chains or our supply chain in the same market that we're selling. And is that even possible?
Carol, that's a very interesting thing. One is the aspiration and the other is the ground reality. The fact is, for decades and decades, we have been relying, no matter what the industry is, whether it's furniture or pharmaceutical or bulk drugs, China is, as I said, the factory of the world. And to try to shift out of China will take a lot longer than what we might assume. Now, there are certain things which are fairly fungible that you can switch out quite quickly, but the entire supply chain, all the way from component suppliers, if I'm talking about manufacturing, to sub-assembly makers, to the final product makers, they're all in China. And you can take piecemeals of that out over time, but we are looking at a multi-decade effort across the board, across all industries, if I were to generalize. So we'll have to live with the fact that our dependence on China is not getting diluted or reduced in the foreseeable future. And when I say foreseeable future, I'm talking about at least for the next 5 years.
So given your experience running this company, the other experience that you've had in Silicon Valley and understanding supply chains of hardware, do we have, as a country, the United States, what it takes to compel companies to build these products in the United States? Do we have that technology? Do we have that ability?
You ask a very difficult question because it depends on what are you referring to. So, for instance, are we trying to replicate a TSMC here? And all the efforts underway. In fact, there's a lot more noise, especially around with the news of Intel yesterday, with Broadcom, TSMC looking at them. But the honest answer is the intellectual capital is still ours. We are the ones who own the R&D. We are the ones who own the design. Now, if you are a Cisco or an Arista, you are getting the manufacturing done by your contract manufacturers like Jabil, Flextronics, Selectron. Bringing those manufacturing capabilities in-house is non-trivial. But given it's our own intellectual capital, manufacturing prowess is still within our hands. It's the investment and the will. And the most important thing that people don't talk about, finding the talent or grooming the talent with vocational skills is going to be critical, but it can be done. But I would say you're talking about a decade or so where our dependence on China becomes less and less. It won't be any time in the future.
Hey, while we have you, Vineet, you guys are all about data. You have been invested. You've received venture capital from Google Ventures, Kleiner Perkins, Goldman Sachs, kind of a who's who when it comes to tech investing, certainly impressive investors. The AI craze that we are in, year 2 and counting, ChatGPT, DeepSeek, everyone's still talking about AI, but it is also kind of interesting how DeepSeek has maybe disrupted the conversation around AI, if you will. Tell us about the demands for your services and what insight you have in this kind of build out to LLMs and AI, this next wave that's been, as I said, 2 years and counting.
My first statement would be is a little radical. I would probably say that the hype cycle on AI is the highest of any tech trend that I've ever seen. And just to remind you, I've been in the Valley for 32 years. I've seen fads come and go, crypto, Web 3.0, you name it, right? But right now, the crescendo in the news, and in fact, the joke is, we get these daily newsletters about investments. Today, I was looking at one, and I saw 11 investments or fundraisers announced. 14. Each of them led AI-driven this, AI-driven that, AI-driven something. So you clearly know that we are at the peak of the hype cycle. But if you leave aside the hype aspect of it, the reality is customers. In fact, as I speak, right next to me is a big conference room. We have one of our largest customers, their CIO sitting with 14 members of my team. And this is one of the largest advertising companies in the world. I can't name them. And the whole conversation is about AI and, of course, all the things we are doing along with other providers they're leveraging. So the challenge is, to be very simple, there is a huge value to be delivered with a slew of these generative AI capabilities. OpenAI is just one of the providers. But the big problem is the value expectation that your customers have today versus the value delivery, i.e. the capabilities we are providing. There's a big gap. And therefore, people are wanting that gap to diminish before it becomes commonplace. But I still maintain all the AI capabilities that we are talking about that are being invented as we speak or will be rolled out in the next 2 years, take my word for it, they'll become commoditized. People would expect that to be included in your product. Over time, what differentiates you or the premium they're willing to pay will be a much higher value stack of services. But it's a journey, and we are on that. So the problem is real. The solutions are real, but the hype cycle is absolutely at the zenith, more than anything I've seen before.
It sounds like, though, this time is different. Words I should never say, so I'm trying to get you to say them. Is this time different than the dot-com bubble?
Yeah, I would not say that. You've heard that phrase before. This time it's different. No, it's just like, you hear about companies being formed in the last week or so with illustrious names. They don't have a business model defined yet, but people are plonking billions of dollars in their fundraise just because of the pedigree of some of these individuals. And not to take anything away from them, this is a classical hype cycle where anything AI, especially when you're talking about LLMs, if you're talking about big data centers, the amount of money being poured into this is crazy. Now, will it have its value? Of course it will, but it will not be commensurate with the expectations that are being created right now.
Wait, so, okay, is it just because it's not there yet and that the hype will become a reality in maybe 2 years? Or is it that the hype is just hype, in your view?
There are two factors. Yeah, so it's a very good question. I still maintain that the value that these technologies will provide are absolutely insane. Even for the things our own engineers build, when I get to play with them, I'm like, holy whatever, this is great. Sorry for that.
That's okay.
But my belief is that a lot of these technologies will become commonplace. They'll become commoditized. So expecting people to pay premium prices is going to be a chimera. People will say, hey, I get it from this vendor and that vendor, so why are you charging me extra $4, $6, $8 per user per month? That'll go away. But also the expectation that customers are having about AI delivering and being a panacea for all the problems they're dealing with without human interaction, or the classical word is AGI, we are years and years away from that. So that is where the hype cycle and the gap between what we deliver is very high, is what I'm alluding to. But I think this technology is here to stay. I mean, Web 3.0 has its renaissance. As you can see, the crypto is back again with a vengeance. So I'm saying that AI will be there, generative AI, but the value hype versus the value delivery, that gap will diminish. And also, the price expectation we have as vendors that you'll pay me this much, we'll have to get grounded into reality that people will pay, but not as what we're expecting. So all the investments we are making right now, in order to get the return, there'll be some, let's say, realignment.
What makes you say that we're so far from AGI?
You know, expecting, very simply stated, having technology today which can reduce the human interaction for low-level tasks in accounting or generating memos or creating a media brief or even an advertisement, that's there. But having it to the point where no human curation is needed or human interaction is needed, and have the faith and belief between you as a provider to say, I can just let the machine or the Gen AI capability deliver the end product, that is not going to be there. It's not there today. It won't be there for a long time. So lights out automation is possible in certain industries, but for the kind of things I'm talking about, where can you invent or have a protein marker for some disease, run through a complete AI-related pipeline and not have a human intervene? Impossible. Of course, there'll be clinical trials for that. But even in our world of software, I don't think our software is at a point today or 2 years from now where somebody could say, let's use this software and let it solve the problem, the complete workflow, with no human looking into it. So that's my reference about AGI, to be honest.
Hey, listen, I really appreciate this. We really appreciate this, getting your perspective. Vineet, one last question then. So if everything may take a few years to work out, in terms of the investments that have gone into an NVIDIA and others, is it a case that that may not make sense, or that will make sense because that's part of the infrastructure build that will still be there in years to come? But whether it's an OpenAI or someone else who leads in this, what you say might be a commoditized business going forward, that's TBD, to be determined.
Yeah, you know, this is a little bit above my pay grade because you're going into the picks and shovel business of NVIDIA versus, you know, the gold from the other guys. The relevance of NVIDIA, I don't see diminishing, except that they will be more competitors. It's the nature of the beast, right? They cannot have this market all to themselves. But also the providers, whether it's, you say, OpenAI or Anthropic or Mistral or so many out there, Google, Gemini, they will, of course, keep up-leveling the value delivery of what they're providing or the value chain of what they're delivering. But a lot of technology that they are investing in today, compared to what the other parties developing, they'll become almost similar and therefore commoditized. So the arms race to be the best or providing the best LLM, that's going to be very expensive. And at some point, there'll be some, I keep scrambling for the right word, there'll be some realignment or readjustment on expectations, even from the investor perspective.
Hey, Carol said it was the last question, but I can't come on our air and I can't ask you this question. When's the IPO happening?
I can't go there. I can't go there.
Well, you could.
One thing I can say is I have run this company very differently coming from the Valley. So you mentioned I've raised 142 million, but also I would like to add the last round came in 2018.
Yeah, it's been a few years.
Since then. Yeah, and we don't plan to raise any private financing in that way because we have been cash flow positive with improving EBITDA margins. But at the same time, I take a lot of pride in saying that I've never built a company which is insanely high growth, with insanely high losses or very high losses. It's predictable, durable growth with improving cash flow mechanics, improving EBITDA margins, so more sustainable. And hopefully the markets will reward us in whatever the outcome is, IPO being one of them.
Well, we certainly appreciate your time and the expertise and kind of industry knowledge that comes with 30 years in Silicon Valley. Vineet, thank you so much. Vineet Jain, co-founder and CEO of Egnyte, joining us there from Mountain View, California, in the thick of it.
Hey, we're in the thick of it when it comes to the trade today. We got about 20 minutes until the close. The NASDAQ flat right now, so we're off our best levels of the day during this session. The S&P 500 up about 0.2% as we speak, while the Dow is up 0.1%.
All right, I am curious to see what our next guest has to say, especially when it comes to the semi space. Take a name like Intel, was up 16% yesterday, down 6% today. It's an area he certainly has been looking at. JJ Kinahan is back with us, CEO of Tastytrade at IG, joining us from Chicago. JJ, good to have you here. Well, great to have you here. Let's start big, broad, and macro in terms of the environment. How do you see it right now?
Well, obviously when you're at all-time highs, it's something that it continues to be a market that people look for bad news, and you can get it pointed out all day long, yet the markets just seems to be resilient and continues to just go higher and higher. I thought it was a real maybe breath of fresh air and encouraging for retail investors today when in the Fed notes they said, well, we're really not sure what's going to happen with the tariffs and what effect that will have on the economy. And I think that it's like, well, you're just expressing what really everybody else seems to be saying. But in the meantime, I look at our clients, they continue to just buy the market. And it's interesting, one of the stocks that they've come back to after sort of maybe not being a bit out of favor, if you will, until the last couple of weeks where we've seen, almost 80% of the activity be bullish is actually Apple. Not quite a semiconductor, but of course, one that's been a lot of people's portfolios, not maybe as much of a traded stock as it is just an investing stock. And it's really interesting how the buying there has picked up pretty significantly over the last few weeks when some of the other Magnificent Seven haven't been quite as interesting.
Okay, we're talking NVIDIA. We talked Meta Platforms. You mentioned Apple, JJ. Caterpillar is an interesting name on your list. Your clients are bullish on Cat. What's going on?
Yeah, that's really not a name we talk about very often, is it? So, a stock that's had a little bit of trouble and kind of turning things back around the other way. And so with that one, again, maybe a bit also of a vote that we're going to continue with a lot of these infrastructure plays with the new president, et cetera. So all that, I think, is adding up to this. Again, when I see a name like Caterpillar on our list of most bullish stocks, the one thing that does make me happy about that is it shows that we're continuing to spread out from just the Mag 7. If you think about a year ago when we were talking about these rallies, we were talking about primarily the Mag 7 stocks. Now you're talking about a lot more stocks being involved. And let's face it, the average retail trader, not necessarily Caterpillar, making the list of good volumes and people having a high interest in it.
All right. So another name you don't like, Starbucks, which we know who has a new CEO.
I don't know if he doesn't like them.
Do you buy coffee from Starbucks?
I'm drinking I have a cup here as we speak.
Okay, all right, just checking.
Wait, so do as I say, not as I do? Is that kind of a thing? So Starbucks, we know, high-profile CEO, came from Chipotle. Brian Niccol, we've talked to him a lot, was really instrumental in terms of driving growth, getting them focused on the digital side of the business. At Chipotle, now at Starbucks, and he's making some changes, but you're not so keen on it. How come?
Well, I think we've seen an incredible run-up in the stock since he's been named CEO. Let's face it. And, give credit where it's due. The anticipation of what he was going to do, followed by, who doesn't love the AC/DC Thunderstruck as their commercials. And the brand new commercial is very catchy. And narrowing the menu, fantastic. But I think that there was this, sense as he took over, people immediately, it took a few weeks, but once some of the employee issues, et cetera, settled down, the stock pretty quickly followed suit in anticipation of this. Now it's a matter of, okay, will the execution all the way down the line follow what's going to happen with the announcements and with them trying to do this. Obviously, incredibly successful CEO where he's been in the past. Can he take that magic again? We saw them talking about opening 500 new stores yesterday. So again, there is a lot perhaps to like there, but I also think that when you have this kind of run, you're at an all-time high in the market. What people start to look for is, okay, those that have run, maybe time to lighten up, or even to take the other side of and look for some of the more beaten down stocks or stocks that have had trouble participating in this upward move. And again, Starbucks has had a pretty good run for the last 4 or 5 months.
Hey, JJ, a member of the Bloomberg Businessweek audience getting in touch. He wants to know about a view on equities moving forward, given we're likely going to see government layoffs, inflation, as the Federal Reserve has said, is sticky, consumer that is weakening. What do you see?
I still see U.S. equities as the best game in the world, so to speak. So people are going to have to put their money somewhere, and they're always going to be looking for return. So, I've just returned from some overseas trips, and it really is amazing to me how everyone is looking to get their money into the U.S. to be part of the U.S. markets right now. We see inflation in different spots of the world creeping up, if you will. I think the part that is going to be the most interesting is going to be the tariff side of this and what's going to be the longer term effect in terms of cost. You had some of the housing stocks released this morning and some of their fears around what this could mean for the cost of housing, particularly brand new housing, and how so many of them had to give away already incentives to get the houses sold. What does that mean if the price of lumber and steel and even things like insulation goes up in the future? That's going to make it much more difficult. But with all that said, when I look around the rest of the world and the competition, there isn't much else that is competing with that on a worldwide scale. So it still seems the best bet in town, if you will.
Well, but just to the point that our listener sent in his question, I mean, if you look at the MSCI World X US Index, so take out the United States, it's up more than 7%, 7.4. If I look at MSCI World Index, which includes the US, it's up about 5%. S&P is up about 4%. So we know, we've all been talking about the start to the year where markets outside the United States are outperforming, and maybe it's a case of just they've been so beaten down, so undervalued. But you don't think that trade continues, that outperformance continues?
I think it's the more we start to see tariffs come up, the more we start to see inflationary pressures rise, the harder it gets on the rest of the world, in my opinion, because of the, to your point, some of this, I think, is people who are like, okay, where can I go next? Just as I talked about the U.S. market expanding out from the Magnificent Seven, to me, the natural derivative of that is to say, what other markets can I go to that have been beaten up? But in my experience, what happens is those markets that tend to go up very quickly, especially if you believe that, the rally may be pausing for a while or correcting for a while, they tend to go the other way very quickly also and outperform on the downside as well as the upside. That's not to say that you can't get better return, but I do think you have to take into the account what's the volatility you're going to take in by doing that. In my opinion, it's much higher almost everywhere else in the world than it is in the U.S. right now.
What's the biggest risk that the market faces right now? I mean, I don't want to say we're priced for perfection, because who knows if that's the case, but we are hovering around records. What could derail this rally?
Well, I think the fear of the unknown is always out there. Of course, it really does seem amazing that we've been able to quell some of the countries having issues, which makes me think that inflation is going to be the number one thing that we're going to have a problem with, because as you also mentioned, yes, there does appear to be not only government employment may be in question, but let's face it, I think that what you're starting to see from starting with technology companies, is do we need as many people as we used to, particularly as AI comes into use? And I'm not ripping AI as taking away jobs, but every time we've seen new technology, in the short term, it does take away jobs, and in the long term, it expands jobs significantly. But we're at a point where we may see higher costs for things at the same time, some jobs being eliminated. And so that combination, I think, does have an opportunity to slow the economy down pretty significantly. And as we all know, the Mike Tyson line, the punch that knocks you out is the one you don't see. So who knows what else could be out there.
Hey, one name that we often spend a lot of time talking about, and I just want to go back to, we know we talked about the Mag 7, Apple, and I'm just looking at, it's just little changed on the day. New phone that came out today, it's down about 2% for the year overall. But when it comes to Apple, you're bullish on Apple. What in particular are the catalysts, or is it just a continuation of what they're known for, or is there something in particular? The iPhone 16e available in white and black, starting at $599, available starting February 28th. That's the headlines. I mean, our Mark Gurman has been
Thank you for letting me know, Carol.
I thought I was hearing a commercial read.
Yeah.
Brought to you by, anyway. But no, we've been waiting for this, and our Mark Gurman has been talking about it a lot. And so that was just some of the headlines that came out late morning. What is it about Apple?
So, it's really interesting. If I look at Apple, let's back up a little bit. Let's talk about Apple over the last 2 years for a second, if you don't mind. So think about, maybe even longer, maybe it's 3 years. Think about that whole buy the dip mentality that we all experienced for a year and a half or so. Apple was the first stock that buy the dip started with. And everybody's like, Apple, Apple, Apple. What happened over the last 6 to 9 months, Apple kind of fell out of favor a lot more with the retail investor, which is really interesting. It had never experienced anything like that since it's become more of a, quote unquote, major stock. And so that had switched over to Microsoft as the company people bought first whenever there was times of trouble. Now we're seeing a lot of different stocks. When Tesla had the big sell-off a few weeks ago, Netflix, we're seeing that's the times that retail investors will step in and buy stocks like that were trusted. I think what's happened to Apple over the last 4 months is kind of where we started the segment. Okay, we're right near all-time highs. What could upset us overall? And so I think one of the reasons that people have become more attracted to Apple overall is exactly what you said. You know what the products are. I don't think there's anything that's so brand new. Yes, AI, it's great to have on there, et cetera. But I don't think that's the primary reason people are buying their phones. They're buying their phones because they know the reliability. They're buying them because they know what they're getting overall. Yeah. And when people are unsure, they go to products they know, they go to names they know. Apple is still a very, very trusted name by most people. And so there has been, I won't say that people have gotten more cautious overall, but toward that they have gotten a little.
Or if they live in the Masser household and they're child of the Masser household, they don't have a choice because it's an Apple household.
What if you have to buy a new AirPods case?
I found mine. Okay. But again, it would be Apple.
Yeah, you'd buy it. Yeah.
Just saying, this is what kind of happens. You get entrenched within the network. JJ, thanks. JJ Kinahan, Chief Executive Officer, Tastytrade at IG, joining us from Chicago.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.